Hey guys, what's up? Chris Peach here with my wife Andrea Robinson, and today we're going to be breaking down investing. Now it sounds like, oh my gosh, we're going to go on this huge investing lesson. No, we are going to simplify it and make it as understandable as possible, because really it doesn't have to be complicated. The truth is, the banks and a lot of the financial gurus out there, they complicate things so you don't understand it. So you have to hire somebody, pay them a lot of money to teach you how to understand it or do it for you. We're just going to break down those barriers right now.
Okay, and this is good because I am not a numbers person. This guy is, right? So we make a good team in that matter, but I really did not, nor do I really care a lot about it. I just don't know enough about it, but it truly is simple. And if I can know about it and learn about it, so can you.
Okay, so the four things that we're going to talk about are stocks, bonds, mutual funds and ETFs will be number 3. And then let's break down some of these things we probably hear in the news, like S&P 500 or the Dow or the NASDAQ, or when you're watching TV and they say, oh, the market's up or the market's down. What the heck do they mean?
Yeah.
Right? We're going to talk about that.
Okay, so let's start with stocks. What is a stock?
So a stock is really simple. So a company will offer shares of their company. Not really ownership in the company, but they'll offer shares. And what they're trying to do is they're trying to raise money to grow their company. So Amazon, for example, Amazon says, okay, we're going to sell shares of stock. So a lot of people think that I own the company. You don't own the company, you own the shares of the company. The big difference there is you don't get to call Jeff Bezos up and say, hey Jeff, I bought some stock. I think you should start doing this with Amazon, right? Because you don't own the actual company, you own shares in the company. Now the cool thing about shares is it's unlimited potential. So if that share goes up in value because the company went up in value, then the value of the company went up. And since you're a shareholder, that value of the share goes up. So you can buy low and sell high, right?
That's always what they say is best.
That's always what they say is best. Now, on the opposite side, there's no limit to how low you can go. So you could buy a share. Let's say you buy it for $100 a share, and the company goes bankrupt. You get nothing, right? So there is risk. So a stock is really higher risk but higher reward. That's one way, is the appreciation pays you out. Now another way you can earn with a stock is a thing called dividends. So think about this. If you own a share in a company, right, and that company goes up, it's more profitable, you get to share in those profits, and those are called dividends. Okay. So a lot of times companies pay that out quarterly or annually, just depends on what their choice is, but those dividends can be paid to you, if you're in retirement, it's good to get like high dividend stocks to kind of keep the money coming in. Or if you're young and you're growing it, take those dividends and put them back into your investment to make that ball even move faster. So stocks are not scary, right? All a stock means is you own a share of that company, right? So if the company says we're going to release 10 million shares and you own one of them, then you're one 10 million share owner of that stock.
You got a little piece of that pie.
When you think of stock, think single, like Apple or Amazon or Southwest Airlines or Target or Wells Fargo or something like that. Okay. Those are stocks.
Okay, that's stock. Got it.
Stocks.
Okay, now bonds.
Bonds. So you know how we all hate debt, right? Well, on a bond, bonds are debt, but you're on the right side of debt this time. So you are the bank.
Okay.
So a government bond, you've probably heard people say, oh, it's a government bond. So let's say the U.S. government wants to create jobs, so they need to create like a jobs report or Jobs Act or something like that. So they need to create jobs, but they don't have money to just throw at these jobs. So what they do is they get a government bond. So they open up a bond to people like ourselves, and they say, okay, a bond is going to be set just like you would if you were getting a car loan. It's a predetermined set of months or years, so it could be 36 months or 5 years, whatever it might be. That's the length of the bond. And so you are going to loan them however much money you want to loan them, and they're going to pay you back that much money plus interest, and the interest rate is predetermined by the bond or by the bond issuer. So I'll give you a quick example. The government says we need to raise $100,000. This is really just a simple number. Okay, so they release bonds out there. So then I can buy a bond, and then the bond can be like a 3% bond, meaning okay, I'm going to loan you $2,000 over the next 5 years, and you are going to get that money back plus the interest every year of 3%. So that is a bond. So think bonds are like debt, except for you're on the right side of that debt. And the cool thing about bonds is they're less risky.
I was just going to say little risk, safe.
They're less risk, and the reason why is, so remember we talked about stocks a minute ago. With bonds, if the company does poorly, bond holders get paid first. So they have to settle with the bond. The stocks are always the last to get paid. The shareholders are the last to get paid. So you have a little bit of, you're risk adverse there. So less risk, but less reward.
Okay.
Absolutely.
Okay, now on to mutual funds and ETF. I hear all the time.
Okay, so mutual funds and ETFs. So think about this, is when you buy one bond and that bond does poorly, then you had all your eggs in one basket.
Sure.
Or if you buy one stock of Amazon and Amazon tanks for some reason, that was a big risk for you.
All your money is
mutual funds and ETFs, for the case of this lesson, we'll just say they're very similar. There's some differences, but let's just say for this, they're basically big buckets of bonds or stocks. So a stock mutual fund or a stock ETF basically could be like thousands of companies. There's one of the biggest one is the Vanguard. I think it's called. We won't go into the symbols, but Vanguard has one. There's over 3,000 companies inside this. So what happens is let's say that you have 3,000 companies, and let's say 5 of them today go bankrupt, right? Well, if you had your money just in those 5 stocks. Remember I told you stockholders are the last to get paid, or shareholders are the last to get paid. That sucks, right? That hurts. But if you have it in 3,000 stocks and 5 of them go bad, you're safe. So it's a way to play a little bit of safety in there by just mixing them all together into one big fund. Bonds are the same way. You could have corporate bonds, you can have municipal bonds, you can have financial bonds, there's all different types of bonds too. So you could have a bond fund as well. The only thing that's different between a mutual fund and a bond is mutual funds, like let's say that they're found in your 401ks usually. So let's say that your mutual fund inside your 401k, like you want to get out of it and you say, okay, you go online, you click sell. It actually doesn't sell until later that evening after the close of the stock market, which isn't a huge deal for some, but for a few, it might say, no, I wanted to sell because I knew the fund was dropping, so I hit sell at 10 a.m. and it didn't sell until later after the closing hours, and so instead of selling at $30, it sold at $20, right?
So you lost even more.
Yeah, where ETFs are instant. They trade just like a single stock. So think like this: an ETF stands for Exchange Traded Fund, is a large group of companies, but they trade like a single stock. So this is just my opinion, but I see that more and more companies and people are moving away from mutual funds. They're going to ETFs because they're a lot cheaper to own. The fees are a lot less, and they're a little bit more in today's age, the way they move. Mutual funds are kind of like, in my mind, dinosaurs.
A little archaic.
Yes.
Okay, and lastly, you hear on the news all the time, stock market's up, down, NASDAQ, the S&P. I need to know about this.
Okay, so every night on the news, you're going to see 3 things. Or if you open up the paper, you're going to see 3 things. You're going to see the S&P 500. Okay, you're going to see the Dow. We'll talk about that. And you're going to see the NASDAQ, okay? So when you hear the market, for the most part, they're talking about the S&P 500. It's the Standard & Poor's 500 of the largest companies in the U.S. So they're domestic companies. Now, the thing with they don't care how they perform. It's just the 500 largest. So the largest to the 500th largest, and that's all it is. And it's a compilation of these 500 companies. And then they look at that and they see how they do overall, and they're saying that's how the market's doing. So when you hear the markets are up or the markets are down, a lot of times they're talking about the S&P 500.
Okay.
So all the companies you've ever heard of, right? So, we're talking about Southwest Airlines,
Sure.
Target, Amazon, Apple. I mean, large, big companies,
names.
all the banks, all the airlines that are really big, all those companies are going to be in there.
Okay.
And there's also going to be, since there's 500, there's going to be companies in there you probably never heard of, but it just goes by size, all right? So the Dow is called the Dow Jones Industrial Average. It's another benchmark they use, but it only looks at 30 companies, right? So you can go online and Google what's in the Dow 30. It'll show you. So I personally like to know what's going on with the S&P 500 because that's giving me a look of 500 companies, where the Dow's only giving me a look at 30 companies. Okay. And then NASDAQ stands for, this is just GWIZ, North American Securities Dealers Automated Quotation System. That's GWIZ. You don't need to know that. Those are tech stocks.
Okay.
So those are all tech stocks. So when you're seeing, the markets go up or the markets go down, really I think the best thing to look at is the S&P 500 because there's no discrimination against if it's in tech or finance. It's just the overall markets.
Okay.
All right. So that's what that means right there.
Okay, makes sense. Okay, so I think we need to address this before we wrap this up. I think a lot of people are scared to invest because they think, well, one, it's money, but also I don't have thousands of dollars to invest, so I'm just not going to do anything. Is that false?
That is false, but that's new actually. So, a decade ago, that was the truth, right? You'd have to have, a couple $1,000s to get into a fund. But today, those barriers have all been broken down. So going back to ETFs, ETFs are very low barrier of entry. And so you can start, like, I'll give you a company. We're going to put a link to a post below this video that we just published on Money Peach. It's called Investing for Beginners. And it breaks everything down we talked about: stocks, bonds, mutual funds, ETFs, and a little bit more that we're not going to get to in this video. But you could start with $1. I mean, it's crazy now. You can invest with as little as $1. So you don't have to save up and say, okay, I need to save up a bucket of money and then invest. You can just get started right now. So there's so many cool things. There's an app out there that we use just kind of for fun, and it rounds up every purchase you make to the nearest dollar and invests your change. And it sounds crazy, but over the time
it's like couch change is what I think of it. That change that you just find laying around, but you just had already spent the money, so they invest the money.
Yeah, we started it about 6 or 7 months ago just to try it out, and we have over $1,000 in change that's invested now into ETFs. So that's one thing. There's a couple other companies out there. They do investing for as little as $1. There's another one that's really cool. It only invests in like social conscious type issues. What I mean by that is your money is not going to go to tobacco or firearms or maybe things that you don't believe in. It's going to go to green solar energy companies. It's going to go to companies that are better for the earth, companies that are more social conscious, health-wise, education-wise. So if you're somebody that's like, look, I don't want to go and put my money in a mutual fund or a stock or a bond, or not a bond, but an ETF, and realize, oh, that went to a company
that I don't agree with.
That makes cigarettes. And you don't agree with that. There's actually companies out there like that. There's companies that are only faith-based, which means you can invest in ETFs, mutual funds that are only based on faith. Which means, again, like if there's any possibility that money would go into a video company that might go into a porn company, it's off limits. Or if there's anything that would go into alcohol or tobacco or anything like that, it's off limits. So there's so many cool options out there. The biggest problem is it's just not well known.
Yeah.
It's just not well known. Like I look at it every single day, so I take it for granted. But these ways to invest with little as $1, no one knows that, right? People think that you have to have thousands and thousands of dollars.
That old adage, knowledge is power, is so truthful in this type of, this part of your living. If you want to build wealth or you want to just at least have a future with money in it, you've got to know this stuff. You're your best advocate.
So another thing too is I talk to people all the time. They have a 401k. And they're like, I don't know how to manage the funds in my 401k. So I found a company, another one, we'll put the links below this video. But what they do is they go and they attach themselves to your 401k, and they will tell you how it's doing for free, which is the good part. And then for $10 a month, they call it Netflix style pricing. For $10 a month flat fee, no contracts, they will actually go in there and in real time, they'll always be rebalancing your 401k for you based on the same algorithms that the financial advisors out there are using. And so instead of going and pay thousands of dollars, this company does it for $10 a month. And if you don't like them, you just say, I'm done. And you just cancel it. It's Netflix pricing. So again, we're talking it's so affordable out there to invest. It's so affordable out there. It's actually so affordable, it'd be silly not to get started. Like you don't have to get started with thousands of dollars, $1 freaking dollar.
Well, and like you've always said, investing is obviously the way to pave your future so that you can continue to live and have something to live on. But also, the sooner you do it, the better, because time is on your side.
Sure. So you can always make more money. I always say this, you can always hustle, you can always make more money, which means you can always invest more money, but you can never get back time. So every single day that you delay investing, it just puts you so far back. So yeah.
Okay. Good
All
stuff.
Right. Investing is super simple. Click the link below the video. It'll take you to Investing for Beginners post. It's going to walk you through all of this. And you know what? All I ask you is just do something to move yourself in the right direction with money. If it's just reading that post, that's great. If it's setting up your 401k with that company that locks it in, that's something else. If it's just talking about it with your spouse, that's something. But do something today that moves the needle.
Love it.
All right, guys.
Boom, da-ba-doom, boom, da-ba-doom.